it takes time. It takes a chunk of the time for preparation. And that is one standard that is sure that ICANN will test. Whether you are writing CR or you are writing FR, ICANN will test IAS 16. They may not bring it as a standard on its own, but one thing that is sure is that they will put it inside all other standards. Can you see my screen now? Please, I know I can't hear you now, but at least if you can see my screen, just say yes. As usual, type yes. You can see the PowerPoint slide. Just type yes so that I'll know that everybody is with me. That's okay. That's Mr. David says yes. This is open layer. Let's just see your own response too. Okay, thank you very much. So quickly, I'll run through what we have done so far from the beginning of the class. IAS 16, property, plant, and equipment. We try to define what property, plant, and equipment is. We talked about the initial measurement of property, plant, and equipment. We moved on to talking about when you are going to be buying now and paying later for an item of PPE. How do you register that in the financial statement? We moved on to talk about exchange transactions. How that when you give up one asset to pick another asset, how that is recorded in the financial statement. We moved on to talk about when there's an exchange transaction lacks commercial substance. We tried to explain what that is. It's in the previous video. You can watch it. And in the note, I'll be posting this note on IAS 16 on the platform this morning. You can run through it from the beginning to the end. Then we talked about the elements of cost, the things that make up cost. Because ICANN can just come and give you the list of transactions that take place. For instance, this example, I treated it. The transactions that take place are now, should you value the assets in the financial statement when you are doing that for the first time. So we talked about if you construct the asset itself, what is the cost of an asset that is constructed in-house? And then we talked about elements that are not part of cost. Elements that are not part of cost. We moved on to talk about subsequent expenditure incurred on an item of PPE, subsequent expenditure incurred on an item of PPE. Then we moved on to talk about major inspections, when the major inspection is to be done, talking about the major overhaul. And we treated that example there. That is, you are buying an item of PPE. It is also estimated that there's going to be a major overhaul at some point in time in the life of the PPE that will be happening frequently. How that the cost of that overhaul is separated and depreciated over the lifespan of overhaul. And it is separated from the main cost of the asset and depreciated separately. So we talked about measurement after initial recognition. There are two models we use in doing that, the cost model, valuation model. Then we moved on to start talking about depreciation and carrying amount, how that we use what depreciation is, a depreciable amount, what it is. Then we talked about the residual value, what it is, the carrying amount, and then the two methods of depreciation we also talked about. So we talked about when asset has major components, parts differently, that they have different lifespan. For instance, you have a vehicle or you have an asset, all these machineries they use, that it has a separate part that has a different lifespan from the life of the asset altogether. They are also depreciated differently. And when you exchange them, it's going to enhance the life of the asset. So it's going to be a separate recognition. Then we went on to depreciation charges, expense, and where it is treated. We talked about when depreciation starts and when it should stop, this commencement of depreciation and cessation of depreciation. We moved on to talk about land and building. You buy a building and you are going to separate the cost of the land from the cost of the building. Land does not depreciate. It is only the building that depreciates. The only land that attracts depreciation will be the one that is a quarry site where there is extraction going on. You buy a land for the purpose of extracting gravel. So the number of years you need to extract that gravel till you finish extracting it, that's going to be the number of years of the life of that land, and it's going to be depreciated evenly over that lifetime or whatever method of depreciation being used. So we moved on to how that we review the useful life of an asset, And when we say when there is a review of the useful life of an asset, that is a change in accounting estimate. We treated that under IS 8. Someone made a request. I think Mr. David was one that made a request that we should treat IS 12 again. I will look for an opportunity to do a video on that, put it on the platform. But there was a video we put, but that day it was not a slide like this that I used. I just was sending in the notes. You can see the notes, which is a screenshot of the textbook I used during this lecture, and then the video. So maybe one thing I need to do is that I will try and do a video that will have a slide like this and someday post it there so that we'll be able to have our class continue without interruption. There is so much for us to do before May, and I hope that God will give us speed. So we treated examples on depreciation, which was the last thing we did in the class, different types of depreciation method, the straight line method, reducing balance method, depreciation by number of units, whatever method they said we should use. And then we talked about a change in the depreciation method is a change in accounting estimate. So I gave an assignment in respect of this in the last class, and I think only Mr. David submitted. Dorothy was in class; she has not submitted the assignment. And I think Michael was also in class that day. Not seeing the assignment submitted. So this morning we'll be going to revaluation of property, plant, and equipment. Revaluation, one aspect of PPE that is very confusing to a lot of people. It is the revaluation of the PPE, how that we have to measure revaluation, and where do we treat revaluation whenever we are to revalue an asset. Where do we treat it? Is it the revaluation surplus? Should it be treated in the statement of profit or loss and other comprehensive income? Or do we take it to, statement of profit or loss? Or should it be treated as statement under a statement of other comprehensive income? You know, our statement of, because we are still going to be doing presentation of financial statement, which is IS1, how we need to present financial statement, profit or loss account, and other comprehensive income. The balance sheet, which is statement of financial position, moved on to the statement of changes in equity, which is a note to the equity elements in the balance sheet. And then we are going on to the statement of cash flow, statement of value added. There will be a special class for that, and I'll be coming to class that day with a real life financial statement that is published. I worked in a firm for 2 years, and I was privileged to lead audit before I left the place. So I prepared audited financial statements, which I'll be coming to class with, so that you will see how it is prepared and how I can actually expect you to present your financial statement in examination hall. But the hardest part in financial reporting and corporate reporting is in understanding how transactions should be treated. How transactions, because they can give you a TB, or they can give you a financial statement and give you additional information. Those additional information will be related to every standard they want to test. They might test it on inventory, which is IS2. They might test it on income taxes, which is IS12. They might test it on changes in accounting policies. They might test on IS16. So all those additional information, when you read them, what the standard says and how you should deal with them is what I'm dealing with first. So after we are done with that, with the standards that I know that frequently I can test, after we are done with that, then we will deal with presentation of financial statement, and then we will deal with group account, how you need to prepare consolidated statement of profit or loss, consolidated statement of financial position, and consolidated statement of cash flow. How that those are also presented, because at final, of course, at CR, you may have to do one of that. Also, even in FR, you still have to do consolidated financial statement. It may not just be as complex as it would be at final. So the person writing final, then the way I'm going to be attending to those issues will be different from the way we're having it generally now. For CR and FR, the same syllabus is the same IFRS. IFRS does not change. Whether you are doing that FR level, you are doing that CR level, IFR does not change. But the only thing is that they may test the elementary part of it in FR and try to test the advanced part of it in CR. So that's why the CR, that's why I'm treating the topic, each standard to the fullest, so that both levels be able to maximize what we learn in it. So, revaluation of property, plant, and equipment. An item of property, plant, and equipment is recognized at cost when it is first acquired. Yes, whether you want to be using cost model subsequently or you want to be using revaluation model subsequently, it must first be initially recognized at cost. IAS 16 allows a business to choose one of two measurement models as its accounting policy for property, plants, and equipment after acquisition. That is the subsequent measurement. That is how you measure it subsequently. The same model should be applied to all assets in the same class. Now, this is very, very important. You can have items of PPE, the plant and machinery is there. That's the same class. Motor vehicles is there. If you see it, buildings is there. Land is there. They have it. Computer equipment can be there. Yes, office equipment. There are assets in these various classes. So whichever method you have decided to use in valuing them is what you must use consistently. You cannot have a set of motor vehicle that you use cost model on and have another set that you use a revaluation model on. No, it has to be the same model you use for the same class of asset. So the two measurement model, like we said, the cost model, you can see it here, the cost model, and the revaluation model, the cost model and the revaluation model, Those are the two models we use. So we have dealt with the cost model in the past. We'll be dealing with some model, cost model that is revalued. Because one thing is, the two models enter into each other. Now, under cost model also, the standard says that at the frequently, it may not be every year if you are using cost model, but they need to determine the fair value of an asset. That is the kind amount of asset according to standard, the kind amount of an item of PPE must be connected in a way. Okay, somebody just joined the class. Let me see who that is. Who is just joining? Dorothy, you are welcome. Let me mute your mic from there. So that you don't have interruption. Thank you. I know you are listening. You are welcome. So cost model, revaluation model, those are the models that we use. So we'll be looking at revaluation of an item of PPE this morning, how that revaluation should be treated in the financial statement, how the revaluation should be treated in the financial statement. So, for example, a company's policy might be to value motor vehicle just like all the explanation I did earlier. Next, we look for accounting for revaluation. When a non-current asset is revalued, its carrying amount in the statement of financial position is adjusted from carrying amount to its fair value, which is normally the current market value at the date of revaluation. So example, we are going to be treating these two examples shortly, which is what we normally do. The examples, we will treat them so that you see when an asset is revalued upward, how it should be treated, and when it is revalued downward, how it should be treated. Say, example of upward revaluation. Land was purchased for 100, maybe they're trying to say 100 million, for 100 million. Yes, there's an error here. On the first day of 2026 accounting period. The business revalues land as permitted by the IAS 16. The land was revalued to 130 at the end of the first year of ownership. So the requirement here is that how should this kind of revaluation be accounted for? That's what we want to do now. How do we account for this type of revaluation? I'm trying to open my Excel sheet before I put it on the screen. How do we account for this type of revaluation? The other one talks about downward revaluation. When you revalue an asset downward, how do we account for that as well? Land was purchased 100 million naira on the first day of 2026. The business values the land so, and then at the end of the day, the land was revalued to 90 naira. Don't forget, land is not a depreciable asset. Now we need to learn differently the revaluation of a depreciable asset. How we need to revalue depreciable assets. So let me share screen and quickly deal with the two of them now. We'll be treating the two of them at the same time because they are in the same question, just that one goes up and the other one goes down. One goes up, the other one goes down. So if you can see my Z screen now, you can type yes so that I can move on. You can see my Z screen now that I just opened. Just type yes in the chat box. If you can see my Z screen now, just type yes in the chat box. Okay, that's very good. Mr. David says yes. You can see it. So we're going to be having our example one as usual. Example one, example one. And this is going to be a revaluation of PPE, evaluation of PPE in accordance to IAS 16. Accordance to IAS 16, revaluation of PPE in accordance to IAS 16. That's what we want to do now. So first one is going to be upward revaluation. Upward revaluation. Upward revaluation. Upward revaluation. When you revalue it upward for the first time. So I'm going to be having the Naira sign as usual here. Let me just use it hash. Rounded to the nearest million. And so the cost of the land, we're talking about land here. Land at cost. So land at cost for the first part, which is upward revaluations. Okay, let me call this one A upward revaluation. A upward revaluation, so that we know that we are dealing with a question A, upward revaluation first, before we go to the one that has to do with downward revaluation. So, okay. So land at cost, land at cost. Land at cost is 100 million at the beginning of the year. So land at cost is 100 million, which is what? Land at cost to be balanced brought forward. Balance BF. Land at cost, balance brought forward, and that's what we are having, 100 million. That is the value at the beginning of the year. Then closing balance, closing balance. The closing balance at the end of the year. Closing balance at the end, according to what they told us, is 130 million naira. 130 million naira. So there is a difference between this closing and the opening balance. There's a difference between this closing and the opening balance, and the difference is 30 million naira. 30 million naira. That difference is usually called revaluation surplus, because to arrive at it, we say equals the closing balance minus the opening balance, and so we arrive at 30 million naira. So we call it revaluation surplus. Revaluation surplus is 30 million naira. So what we are saying is, how do we treat this in the financial statement? Now, the double entry. I want to put the double entry here for revaluation surplus. Double entry for revaluation surplus. The double entry for revaluation surplus is what I want to put here now. Double entry for revaluation surplus. Now, so I have a debit here. I have the debit here, DR, and I have the credit here, CR. So this is how we treat it. We are going to debit land. Land will be debited with the 30 million naira. Okay, let me just put the naira sign there, rounded to the nearest million, so that it does not confuse us when we are trying to study it back on our own. This loading is acting up. I have a lot of things I do on my system, so it's trying to slow it down. Try to work on that this week. So we have it here. We have this here. That's that. The naira, the million. So as for us to be able to know that it's not just mere 30. So, and we credit what OCI, other comprehensive. Or let me just put OCI here. The meaning of OCI is other comprehensive because of space. We credit OCI with the amount. Credit OCI with that amount. That is revaluation. We now call it being the revaluation surplus. In the revaluation surplus on land for the period. That's it. That's going to be what the description will be. Being the revaluation surplus on land for the period. Revaluation surplus on land for the period. Sorry, I'm coming. Let me just make sure that is it. Revaluation on land for the period. That's the first journal. So that's it when it is revalued upward. So when we take 30 million to the land will now become 130. And the other will go to OCI. Don't forget, okay, don't worry, when we are doing presentation of financial statement, you will see how that this information moves from the OCI account to what we call revaluation surplus account. Revaluation surplus account. That is the account where we keep revaluation surplus. It's always in the statement of changes in equity. Always in the statement of changes in equity. Revaluation surplus account. That's where it goes. So the second one, downward revaluation. Downward revaluation. That's B. Part B of the question. Downward revaluation. Downward revaluation. Downward revaluation. Downward revaluation. That's what we want to do now. For the downward revaluation, we are going to be having, as we had it here, let me move this information down to this place. As we had it here, we'll be having the same thing here. Land at cost, but in this place, the closing balance is 90. The closing balance is 90. You can see, because I'm putting formula in Excel, it has adjusted it. The closing balance is 90. Now, how do we arrive at the difference? You will say closing balance minus opening balance. That's how to know. If there is surplus, it will be in positive. If there is no surplus, it will be negative. You can see closing balance is 90. Therefore, we have impairment. Now, this one we did that we take to OCI is the first time revaluation upward that surplus will happen in the A part, and this is the first time also in the B part that downward revaluation will happen. We'll be treating examples of when it went up 1 year and it came down 1 year. So let me put this one here also and say being revaluation deficit, being revaluation deficit during the period. That's it. Okay, sorry, that's not the journal. I need to first do the journal first. Let me do the journal. The journal, the double entry when revaluation goes down, double entry when revaluation goes down, double entry when revaluation goes down. This double entry, it's going to be the other way around. You are going to debit profit or loss account, profit or loss account, and then credit land, which is the asset, with the amount of the revaluation, which is 10 million naira, with the amount of revaluation. That is it. Being revaluation deficit for the period. Being revaluation deficit for the period. Being revaluation deficit for the period. That's how revaluation is treated when they occur for the first time. When the revaluations happen for the first time. This is how they are treated in the financial statement. So the complex part. So please let's take note. It is very important here, this example one, that we are talking about revaluation of PPE in accordance to IAS 16. I'm talking about upward revaluation. Let me say first time upward revaluation, so that we know we are talking about first time upward revaluation, and then we have first time downward revaluation. First time downward revaluation. First time downward revaluation. Downward revaluation. Downward revaluation. First time downward revaluation. That's it. Now, there is what happens when it is a second time. I hope everybody can see what I've done on the screen. You can see it's example one. What we have treated is the revaluation of PPE in accordance with IAS 16. We talk about when the revaluation is done for the first time. I'll talk about when it is done. Also, when it goes up for the first time and when it comes down for the first time. You can see the double entry for when it comes down. You will debit profit or loss. When you debit profit or loss, it means you are treating it as an expense during the period. So it's going to be taken to the cost of sales in the statement of profit or loss. I'm going to be saying impairment of asset. That's the way I'm going to be calling it. Okay, let me quickly do financial statement extract. Financial statement extract in respect of this transaction, so that you know what it looks like. Financial statement extract. Financial statement extract. So first, we are going to be having statement of profit or loss. Statement of profit or loss and other comprehensive income. That's the name of this statement. Statement of profit or loss and other comprehensive income. So if we have that here, let me have the Naira sign somewhere here, taken to the nearest million. So we have the Naira sign here. So the first thing, in the first year, when there is upward, this I will treat the one for this one upward here. When there is upward review, is that under the statement of profit or loss, there will be nothing. You have nothing here. It's not going to affect statement of profit or loss. But under the statement of other comprehensive income, other comprehensive income, we are going to be having what we call revaluation surplus. Revaluation surplus. Revaluation surplus. Revaluation. Okay, the person I'm waiting for has. Let me quickly add that to the class. Oh, Ms. Ogunle, you are raising up your hand. You have something to say. Please type it in the chat box. Let me add our new. Yes, I just added. Madam, you are welcome. You can join the video. You can join the video as just chat. I've been waiting for you. She has not joined the video. Let me tell her. I'm waiting for Mrs. Ogunleye's comment. I can see you are typing, so are the one I'm waiting for, so I can know what the matter is. I see you raising the chat. So, madam, you are welcome. You are welcome to the class. She here. Still waiting for her. Okay. Okay, I wanted to ask, where do we post the downward? Okay, yes. Okay, thank you. That's the question I want to ask. So I'm going there. Going to the place. Let me quickly. Reply so that she will know that I have opened the class for her. So that's it for the downward. Now, so for this upward, it's coming here. The figure will come here. The 30 million naira will come here. That's where you're going to leave it. For the upward revaluation, when it's happening for the first time, upward revaluation, financial statement extract, when it is upward revaluation, So let me do the one for downward revaluation here. Financial statement extra, when it is downward revaluation. Let me do it beside this one that we treated here. When it is downward revaluation, you are going to be having what we call impairment here. Impairment of assets. That's what you're going to be having here. Impairment of asset, and in this case, we are going to be having the 10 million naira in jacket. The 10 million naira have to be in jacket. It's going to be negative, because this is a statement of profit or loss, and the revaluation. Okay. There was an information there before. So that's the only posting that is required when it's an impairment. Nothing goes to the statement of other comprehensive income. Only the impairment. That's why you can see debit statement of profit or loss. Debiting it is that we are posting it there. Debit is there, and credit line. So this is pure health. So let's quickly do statement of financial position. Statement of financial position. For the statement of financial position, we are going to be having, okay, you are welcome, madam. I can hear the background noise from your hand. I've been waiting for you. Welcome to the class. You meet us well. So I will mute your mic from my hand here to avoid any interruption in the background. But if you have anything to say, you can use the chat box. You are welcome. Thank you very much. So, statement of financial position, when the revaluation comes down, it goes under land, which is PPE. So we are saying land, and for land, we are going to be having the value of the line, which is the new value as at the end of the year. Don't forget, the closing balance of the asset goes to the balance sheet. That is the only information that will be coming here as far as this asset is concerned for statement of financial position. So for here too, when it is revalued downward, the value of the land at the end of the day be taken here, and what we are going to be having is the land will now be worth 90 million naira, which is the balance as at the end of the year when the value goes down. So that's how this is treated in the financial statement when it's happening for the first time. Don't forget I said when it's happening for the first time. So I'm going to be grouping everything I've done for the two in one box so that when you want to review it, notice example 1 that we have treated like this, example 1 that we have treated like this. So example 1 that we have treated like this. So that's it for example 1. Does anybody have any question? There's no question because of time. Let me quickly go to the next example. Now I've moved on to the slide, and I hope you can see the slide. So we have treated these two examples, revaluation upward and revaluation downward. Now there's a question here. They said this is a revaluation deficit or fair value loss. Dangote Limited acquired a parcel of land on 1st January 2006 for 70 million. At 31st December 2006, the land was revalued to 65 million. The land was subsequently revalued to 61.5 million as at December 2007. Required, explain how the revaluation differences will be accounted for in the book of Dangote Limited. Now, the difference between this one is that the same asset revalued upward and revalued downward. Don't forget in the last example, we treated them as if they are different assets. Now, let's now assume that this one that was revalued upward previously is now revalued downward in the following year. How is that going to be treated? That's what this example is talking about. I hope you can see this Dangote example. Can you see it? Please type yes if you can see it, because it's a snap it from my textbook to put it here. If you can see this Dangote example in words that I put here, just type yes in the chat box very, very, very quickly. Okay, Mr. David says yes. So if you can see it, I believe everybody can also see it too. Okay. So, Madam Desi, you also be interacting with the class by putting your information in the chat box so that we can know you are also following. So that if you have any question, you can also draw our attention to it immediately. So I want to treat this as our example 2 in our worksheet. Example 2. Example 2. And this example 2 will be this example 2. Example 2. Example 2. Okay, so I'm seeing that's very good. Okay. You are chatting in the other room box. Please chat in the classroom. That place you are chatting, madam, is for that's the general place. It's not the classroom. So please chat in the classroom. Just click on that corporate and finance this thing. That's the classroom where you can chat. That's where you join the video from. You can be chatting from that place, not from the other end. So that everybody, this is just the classroom for this class, this course. So that example 2 is what I want to treat now. Example 2. So it's going to be what? Revaluation of an asset. Revaluation of an asset, or let me say, okay, let's call it movement in the value of an asset as a result of revaluation. How there is movement in the value of asset as a result of the revaluation method. That's what we want to do here. So this question says, Dangote Limited bought this parcel of land. So let me put the name there. I know Dorothy likes the name of the company very well on top of the financial statement. It's very, very good. So Dangote Limited. That's it. That's what we want to treat now. So we want to be looking at the date that they bought this land. They bought it on 1st January 2006 for 70 million. This is dollars that we're using naira here. That's the day they bought it. So, but the first time they revalued it on 31st December 2006, the land was valued to 65 million naira. Don't forget, land is not a depreciable asset, so no depreciation is charged on land. So we are going to be saying financial. So we are going to be having it here. The first time we are going to be having it here is the 20. We have the opening balance January 2006. Then we'll have December 2006, and then we'll have December 20x7. December 20x7. So let me put the Naira sign here to the nearest million so that we just be dealing with 70. We won't have be typing figure. So 1st January 20 x6. 1st January 20x6, the land had a value of 70 million. That's how much it had. But then by 31st December 20x6, the land came down to 65 million. Then further, by 31st December 20x7, the land went to how much? The land went to 61.5 million. 61. Don't forget, this is land. It does not depreciate. This is land. It does not depreciate. So 65, 61.5. So 61.5. Now, what has happened? Between this opening and closing, we are going to be having a difference, which will be in the middle here. The difference will be closing balance minus opening balance. You can see the difference is in jacket. Definitely, it's what? It's an impairment. It's an impairment. Impairment. So we're going to be having it. So let me say land at cost. Land at cost. Land at cost for this place. I'm going to be having here impairment on land. Impairment on the land is 5. So we are going to be having this balance stated here. The balance is stated here. That is it. For the first time that the thing is happening, that is it. When it's happening for the first time, that's how to state it. And then in the second year, you can also check the difference between the closing balance minus the opening balance. Don't forget, closing balance from 31st December 20x6 is the opening for 20x7. That's why we don't need to be writing 20x7 again. So you will see also that it's in jacket. Therefore, it's also a further impairment in the value of the asset. So what we're having again is an impairment. So the value here will also be what? Is 65, 61.5. This one seems to be a very straightforward question. It's a very straightforward question. Very straightforward question. So it does not give us so much, but we're still going to be dealing the one that goes up and then it comes down. The ones that goes up and then it comes down. So that's going to be what we are going to be treating next. So impairment of asset is it, and so the financial statement extract is going to be just like what we had in this case, just like what we had in the statement of profit or loss in this place. So the balance sheet, financial statement extract. Let me have that here. Financial statement extract. Financial statement extract. So here we are going to be having the impairment. Only the impairment will come to this place in the first year. So let me say this is 20. Let me take this a little down so that I put the year on top. This is 20x6. And then we are going to be having 20x7 here. 20x7. 20x6, 20x7. 20x6, 20x7. Let me clear those borders. So for 20x6, there's an impairment of how much? An impairment of 5 million naira. It's going to be in jacket. For 20x7, there is an impairment of 3.5 million naira. Nothing goes to other comprehensive income. Nothing goes to other comprehensive income. This is how this will appear in the financial statement of profit or loss for the period, because it's an impairment of land happening for the first time. So statement of financial position statement of financial position. So let me have that here for this example. Statement of financial position. So what are going to be having? 20x6, 20x7, 20x6. We are going to be having 20x6 here, and then we have 20x7 here, 20x7 here. So land is going to be what we are going to be having. What's the value of land at the end of 20x6? The value is 65 million. It comes there. And what's the value of land at the end of 20x7? The value is what? 61.5 million. That's going to be what the balance sheet will look like for this transaction. Yes, land, which is under PPE. That's what the balance sheet will look like for this transaction. So let me remove this border so that everything here is clearly stated. That's what the land will look like for the balance sheet, and this is what the profit or loss account will look like for the period. This example seems simple and straight. Seems simple and straight over the life of the asset. That's what we are going to. That's what we shall be having. That's what we shall be having over the life of the asset. For the 2 years, sorry, not over the life, but for the 2 years of the asset, that's what we are going to be having. That's that. I don't know if you have questions regarding this. Before I quickly go to the next one, I want us to see how much we can accomplish with speed this morning. This standard takes a lot, and I want us to achieve as much as we can this morning, as far as this standard is concerned. Okay, I'm trying to dress the face of the financial statement for easy accessibility for those of us who might want to be studying it later. Do you have any question based on this? No, I'm not seeing any question yet. If you have any, please don't hesitate to ask. Don't hesitate to ask if you have any question. Don't hesitate to ask. Okay, quickly, let me go to the next example. That is done. So let's have this another example. It said asset carried at a revalued deficit is revalued upward. Now, this is where the complications are coming in. Asset carried at a revalued deficit is revalued upward. An asset might be carried at an amount lower than its original cost as a result of being revalued downward. If the asset is later revalued upward, the revaluation increase is recognized in the statement of profit or loss to the extent of the previously recognized expense. That part of any increase above the previously recognized expense is recognized in the statement in the usual way in the other comprehensive income. That's according to IAS 18. Asset carried at a revalued surplus, revalued downward. Also, an asset might be carried at an amount higher than its original cost as a result of being revalued upward. If the asset is later revalued downward, the revaluation decrease is recognized in other comprehensive income. To the extent of the previously recognized surplus, the part of any decrease above the previously recognized surplus is recognized in the statement of profit or loss in the usual way. So we have this example. Now, downward revaluation accounted for under IAS 16. A business purchased a plot of land on the first day of 20x6 accounting period. The business applies the IAS 16 revaluation model to the measurement of land after initial recognition. The business has a policy of revaluing land annually. It revalues land annually. The initial amount recognized and the year-end values are shown below. So these are the values of the land as recognized. So measurement on initial recognition. Value is 100 million. That's okay. We take that as 100 million. 100 as there. Value as at 31st December 2006 was 130. Value as at 31st December 2007 was 110. You know, this is land. It does not depreciate. The value should have been constant if there is no other challenge relating to the fair value. It should have been a constant value that we are going to be having. But now it's going up and down as a result of revaluation. So 31st December 20x8, 95, and in 2019 it goes to 116. So let's quickly treat this example. So we're having it as our example 3. So I'll take it here and say example 3. Example 3. Example 3. And in that example, we are going to be talking about movement in the value of asset as well, just like we did before. Movement in the value of an asset as a result of revaluation. Movement in the value of an asset as a result of revaluation. That's what we are still treating under this example. Movement in the value of an asset as a result of revaluation. So what we are going to be doing first is to state the asset. We are going to be stating the asset initially recognized because it was bought on the first day of January 20x6. So as at the end of 20x6, it became 130. So we are going to first do the schedule for the asset, which is our workings. The schedule for the asset, I want to take the million naira sign. So, oh, sorry, what's this? So, this will just show what the schedule of the asset. Land schedule. So in at the beginning, which was 1st of January /20x6, 1st of January 20x6, so which is at cost. The land was how much? It was 100. Sorry. Speaking that as a formula. No, I don't want it as a formula. At cost. At cost, the land was 100 million. 100 at cost. But then at the end, which is 31 December 31/12 20x6, 31/12/20x6, they said the land became how much? Which is there? Value as at 31 December 20x6 is 130. 130. So it became 130. So what has happened during the time? Just like we knew, closing minus opening, there is a revaluation surplus of 30 million. So we have it a revaluation surplus. Revaluation surplus. Revaluation surplus. And then we have it there. Revaluation surplus is what? 30 million naira. So we do this as our closing balance for that year. And then we go to 31st December 20x7. 20x7. Then they said the land became what? As at 31st December 20x7, it is 110. 110. We are still doing we'll be doing the double entry now, but we are still doing the schedule. So to present it the way it should be. So 110 is what it became at the end. So what happened in the middle? We create closing balance minus the opening balance. So we have negative 20 impairment. This time it's an impairment. It's an impairment because it's in negative. That's how to do it. If you take your closing balance first, before you deduct it from the opening balance, you will know whether it's an impairment or not. It's to give you a negative sign. It's an impairment. An impairment is the closing balance. Then we are going to be having 31st December 20x8. 20x8. 31st December 20x8. What's the value as at 31st December 20x8? The value has come to 95. 95. So we say 95 million naira. So something has happened in between again. We deduct this 95 minus the opening, and so we see an impairment also, an impairment of 15. It's negative, so it's an impairment of 15 million naira. So we also do this closing, and then it goes on to 20x9. It became 116. 116, 20x9. So 31 December 31/12/20 x9. 31 to 20 x9, and then we have 115, 115. That's the value. Something happened in between. The closing balance minus the opening balance. So what we have is revaluation surplus. Revaluation surplus. Evaluation surplus. That's it. Evaluation surplus is 20 million. Now, the task here is, how do we treat the double entry? How do we treat the double entry over the life of this asset? So I'm going to be doing the journal now. The journal, so I have the dates here. So I'll say journal. Let me say journal. And so if I'm doing the journal, I'll have this column for dates. So the first journal will be passed at the end of what? At the end of, so let me first do my debit, credit column. Debit, credit column. The first journal will pass at the end of 20x6, 20, so I'll say 31 December, 31/12/20x6. 31/12/20x6. So we'll have that here. So the first journal will be passed. What is the journal that will be passed this year? What we had in the first year is what we have in the first year is a revaluation surplus. Revaluation surplus. So the double entry for revaluation surplus is that we debit the land, we debit land, with how much? The amount of surplus we had, which is 30 million, and credit OCI. Don't forget, the full meaning of OCI is other comprehensive income. That is the information I treated in the first example. Don't forget, other comprehensive income is the full meaning of OCI. You can write it down so that you don't forget. I'm using that abbreviation for us to save space. So we debit we credit the OCI. That is the first time. So the explanation will be what? Being revaluation surplus on land during the period. That's the first thing we are going to be doing. Being revaluation surplus on land during the period. Revaluation surplus on land during the period. So let me wrap it here. That is the description for that journal. Then we are going to be having 20x7, 31 December 31/12/207. Just 1 minute, please. They have taken light in my area. I want to, before the network goes off, because the one I'm using initially is directly connected to electricity, but my backup battery is still holding it. I want to quickly make arrangement for the switch in the network so that before they bring back the lights, it will not disappoint. Just 1 minute, please. Yes, let me make preparation in advance before the issue becomes. So if there is a switch, technical switch, you will know, but to avoid that interruption, I want to make preparation in advance. Just 1 minute, please. Okay, so let me quickly connect to this second network before the light goes If you can hear me, say yes in the chat box. Let me start. Can you still hear me? Can you hear me? Okay, 1 minute. 1 minute. Can you hear me? Everybody? Please, if you can hear me, say yes. I just switched my network. Okay. 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 So I've seen 2 yeses. That's fine. That's fine. So let me go back to where I was. I needed to make that switch before we had issues with the network, because these people can be very funny sometimes. They can be very funny sometimes. Just 1 minute. Let me check. Just hold on for me a minute. Let me check the recording process if it is not affected yet. The recording process, if it's not affected, yes. Okay, coming. I think it's still intact. I think it's still intact. Okay, you said yes. Thank you. Is this our people, electricity people? They can embarrass somebody sometimes. Okay, the recording is still ongoing. That's fine. So we were treating this. So we are passing the journals. So as at 31st December 2007, 31st December 2007, something happened. There is an impairment of 15. Okay, impairment. There's an impairment during the year of 20 million naira. An impairment of 20 million naira as at 2007. Now, how do we treat this impairment? There was a revaluation surplus previously that took 30 million naira to other comprehensive. Now we have an impairment of 20 million naira. How do we treat it? The double entry is simple. First, we debit OCI. Debit OCI with the amount previously credited to it. That is, we are going to be reducing OCI by this new amount. The only reason why any of this amount will go to profit or loss account is if it is above the amount we previously credited to OCI. So OCI is the first thing we are trying to, we debit OCI with how much? Let me put the debit credit here so that everybody can see the debit credit. So OCI is going to be debited with this loss. OCI will be debited with this impairment loss. And the purpose of it is so that it can reduce the revaluation we kept there previously, and we credit land. We credit land with the same 20 million naira. That's how to treat this impairment when it's happening for the first time. So being impairment of land during the period. Being impairment of land during the period. That's the explanation we are going to be giving to this journal. Being impairment of land during the period, 20 million. You can see. You see how that is done. That's how it is done. This is how it is done. When you previously revalue an asset upward, and that asset now comes down. See the video and not the solution. Hey, sorry. Let me check. You're not seeing. Oh, sorry. Please, let me share the entire screen. Now, can you see now? Please, if you can see the sheet, please, can you please put it in the chat box? If you can see now, can you put it, please? I'm sorry, because when I did the switch, I didn't put on the screen again. Can you see now? Okay, you can see. Madam Daisy, if you can also see it, please. Thank you very much. Now, what I'm saying is that this, the first time it was revalued upward, we had revaluation surplus. The first journal in the first year was this. In the second year that the thing goes down, we will first go and debit what we previously credited in the first year, because it's an impairment. It will not go. Don't forget, in the journals we have been passing for impairment, what do? We take impairment to the statement of profit or loss. That's the double entry we have been doing before. We take impairment to the statement of profit or loss in the double entry. Don't forget that what we did. That's what we did here in the first time that we did the journal. We took it to the profit or loss. You can see this example here. But now that because the asset was previously revalued upward and we are taking 30 million naira to revaluation surplus account, which is OCI, we must first reduce it with the amount. The only reason why any amount here will go to profit or loss account is if it is over and above this 30 million that was previously credited. So now let's go to 31st December, 31/12/20 x 31/12/20x8 now 20x8 31/12/20x8. Now by 20x8 there was a further impairment of 15 million naira. 15 million naira. How do we treat this? Now this is a double entry for this, and please don't see it as complicated. The way it should be done is the way I'm showing us now. The way it should be done is the way I'm showing us now. Let me move the date here. So the first thing we are going to be doing is to debit OCI further. Debit OCI. Debit OCI with how much? With the 10 million naira remaining in OCI. It was 30 million naira we took there before. The first year, the second year after, which is 31st December 20x7, we took 20 million there to reduce it. Now that we have further impairment, it is 10 million naira remaining in OCI. We take it there and we say we debit again what? Profit or loss account. Profit or loss. With how much this time? 5 million naira. You see, because that is the only excess we are going to be having. And then we do what? We credit the land. We credit land with how much? 15 million naira. The 15 million naira, that is the addition of this plus what we put in this place, 15 million naira. And it's going to still be what? Being impairment of an asset. Please, do you get what I have done here? Do you get what I have done here? This is how the journals will be passed. This is how these journals will be passed. You can see, this is how the journals will be passed. This is how the journals will be passed. First, debit OCI with everything you have taken into OCI for the first time. And then what do you now do? You credit the land. Then the other part, which is over and above of what was previously there. Okay, let me just put this one debit credit also there so that if you are doing revision, you'll be able to see exactly what we did. Debit credit here. So that's it. So this is 20. So I'm going to put each journal in a box for us to be able to see when we are reviewing it. Journal relating to 20x6, journal relating to 20x7 separately, and journal relating to 20x8 separately. You can see. Then there is a further information we have, 20x9. As at 20x9, you can see we have what? Revaluation surplus in 20x9 on the same asset. Revaluation surplus of 20 million naira. So what are we going to be doing? The double entry for this one, double entry for 20x8 this time, double entry for 20x9. So 31st December 20x9, 31/12/20x9. 31/12/20x9. So what are we going to be doing? What are we going to be doing? How much revaluation surplus do we have? They have brought back our light. Thank God for that. How much revaluation surplus do we have? We have 20 million naira revaluation surplus. So how are we going to be treating this? Now, this is how it is. It's a little bit technical, but watch it. These 5 naira that we have taken to the profit or loss account must be recovered back now that the land has appreciated again. So the first thing we are going to be doing is what? We are going to first debit how much? We debit the land with how much? 20 million naira. So land is debited with 20 million naira, which is the total amount that has gone inside it. Then we will credit profit or loss account. Profit or loss account. We credit profit or loss account with how much? The amount we took there previously, 5 naira. And then we credit OCI. OCI with how much? We're going to be crediting OCI with 15 naira. 15 naira. Being revaluation in the value of the asset, being revaluation surplus on land during the period. Being revaluation surplus on land during the period. That's it. That's how the journal will be passed. Revaluation surplus on land during the period. So we are going to have it like that. Now, if you have any question, this is what journal for 20X9 in a box separately for us to be able to see. Look at the journals. Can you see? Now, the next thing will be that I'll be doing the financial statement extract for these years. The financial statement extract for these years is what I'll be doing now so that we can see what the financial statement will look like for the period. What the financial statement will look like for the period. Do you have a question? Let me check if anybody is trying to put in a question there. Okay, I will watch the video. Okay, Dorothy, say I watch the video and note later. I'm just coming back from PG. Oh, sorry. Go and sleep. I understand. Don't worry. So anybody with any question? Dorothy is the one talking to us about that. If you have any question, Mr. David, you're typing, watching what you're typing. If you have any question on the movement in this asset value as it relates to what we just did now. Do you have any question? 116 to 95 should be 21. Okay, is it 116 there? Let me check. Oh, 116. I was thinking 121. Thank you for drawing my attention. So even in the schedule that we did here, that's where the problem came in. We put 115 there. 116, sorry. Okay, everything will change. So it will be 21, true. So this will be 21. This will be 21. It will be 21, which is what should be here. With 21. And if it is 21, we take 5 here and we take 16 here. That's what it will be. We take 5 here and we take 16 here. We won't take more than 5 to profit or loss account because 5 was what we debited here previously. So let's look at the financial statement extract over this asset. Financial statement extract. Financial statement extract. The financial statement extract. Financial statement extract. So I'll first have a statement of profit or loss over this asset, statement of profit or loss, statement of profit. Sorry, I want to put this in log form. Statement of profit or loss and other comprehensive income. Statement of profit or loss and other comprehensive income. And we're going to be having all the years 2006, 20X7, 20X8, 20X9. So let me have it here. So we have 20X6, 20X7, 20X8, 20X9. That's going to be the years. So let me put a sign under it, the Naira sign under it. So first, and then we are going to be having the other part of it, which is going to be what? Other comprehensive income. Other comprehensive income. So let me put that one here. Other comprehensive income. Other comprehensive income. Other comprehensive income, which is also part of this statement. That's why we call it statement of profit or loss and other comprehensive income. The upper side is the statement of profit or loss. The lower part is other comprehensive income. So what is going to be happening? Now, based on what we did here, the first journal is what? Debit line, credit OCI. So we come under OCI for 20x6, we'll say revaluation surplus. Revaluation surplus. Revaluation surplus. And what is that going to be? Revaluation surplus in 20x6 was what? How much? 30 million naira. 30 million naira. That's it. Then for 20x7, what we had is what? An impairment. So which reduces what we call, so we'll come here and say what? Impairment. Impairment, which is a reduction to this. It's going to be in jacket because it's in jacket here. That's it. For 20, sorry, that's for 20x7. Under 20x7 this time. We are debiting OCI with what? The impairment we had in 20x7. So in 20x, which year next? 20x8, what happened? For 20x8, there's a further impairment. Of how much? 15 million naira. So, and we say what? We are taking that impairment also. Impairment for 20x8 that is going to profit or loss account is how much? Is 5 million naira. So we come under 20x8 and we say it's going to be in negative 5 million naira. 5 million naira. Let me take the figure from here. 5 million naira. That's impairment for 20x8. And there's a further impairment that is taken to OCI because of what was previously recognized in OCI, which is 10 million naira. It's an impairment of 10 million naira that we are taking to OCI. You can see how this is being presented. 10 million naira taken to OCI. You see how this is being how you are going to present it in the financial statement extra. This statement of profit or loss. Statement of profit or loss. Then in 20x9, then something happened in 20x9. There is a revaluation surplus. What is the transaction? We credited profit or loss account with 5 naira and we credited the OCI with how much? 16 naira. So OCI, we take revaluation surplus again. Revaluation surplus, which is how much? 16 naira. 16 naira. We come here and put it 16 naira. 16 naira. And then we are going to have what we call this also revaluation surplus. Revaluation surplus for the one that goes towards, that goes into this place, and that will be how much? The 5 naira that was taken there previously. So we are going to be having 5 naira here. In this case, it's going to be positive 5 naira because it's a credit to the financial statement. This is what the financial statement of profit or loss and other comprehensive income will look like over the life of this asset. So quickly, I will do statement of financial position. 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 And so first, we are going to be having the PPE, which is non-current asset. So let me copy the years and the naira sign down to the place as we are supposed to have it. So the first part of it is going to be our PPE, non-current asset, non-current assets. And so we have land. It's land we are dealing with. land. In 20x6, land was how much? 130. In 20x7, it became how much? It became 110. In 20x8, it became how much? It became 95. And in 20x9, it became how much? It became 116. That is the PPE. So the other part we'll be working on now is equity. Equity, okay. I didn't put that equity in this place. Okay, don't worry. Okay, that one that has impairment does not have equity. So we are going to be having, don't forget in balance sheet, we have non-current asset, current asset, then we have equities and liabilities. So under equity is where we normally put revaluation surplus. So we're going to be having revaluation surplus, revaluation surplus slash deficit. Impairment is also deficit, we call it revaluation surplus slash deficit. So we have in the first year, which is 20x6, there was a revaluation surplus of what? 30. Took it to OCI. From OCI is where we pick the figure. You can see. For 20x7, we are going to be taking how much there? Revaluation surplus will now be what? This amount minus the impairment. Revaluation surplus accounts will now have 10 million. You can see. Then in 20x8, what happened? The revaluation surplus will also be taking a further deduction. That is this 10 million naira minus the 10 million naira that was experienced. It will be zero. No revaluation surplus at the end of 20x8. But in 20x9, we now have another revaluation surplus of 16 million. You can see that's going to be. So initially, the value of the land was what? 100 million. By the end of the period, the value of the land was 116 million. So as at the end of that period that we worked on, the valuation surplus account will be having 16 million naira, which is the current increment on the what previously recognized on the asset. It was initially 100 million, don't forget, at the beginning at cost, but at the end of 2019 it's 116 million. So as at the end of 2019, the land will carry 116, and then the revaluation surplus account will carry 16 million naira, which is the increase on the value of the land. So that's it. Do you have a question on this? Before we go to quickly take one more example. This is a revaluation of an asset that does not depreciate. We'll now be dealing with revaluation of an asset that depreciates. That's the example I will quickly treat before we close the class this morning. So that one is a little bit complex, but this one that does not depreciate is easier for us to be moving. The one that depreciates, how do we do it? That's exactly what we are going to be looking at. Somebody is typing, Mr. David is typing. I need to know exactly if you have any question based on what we have done now. If you have any question based on what we have done now, quickly we can resolve it together. If you have any question based on what we have done now, we can resolve it together. I'm waiting for your responses. I'm waiting for your responses regarding those things we have treated here. How that the revaluation account changes. So please, between 20x8 and 20x7, impairment should be 15. Why did they split to 10 and 15? Thank you very much. They are 15 on land. Look at it. This is double entry. They are 15 on land. But one thing is, when an asset is previously revalued upward, and that same asset is not a different asset, is now revalued downward, having an impairment. First, we must reduce the previous impairment, the previous surplus that asset had that we have put in revaluation surplus, which is OCI. We must first reduce it. If it's now in excess, that is, if the impairment is now in excess of what we previously had as surplus, then we take the excess to profit or loss account. Ordinarily, when impairment happens for the first time, it goes to the statement of profit or loss account. But when this impairment is happening on an asset that was previously revalued upward, first, the impairment must be treated in OCI, where we took the upward review to previously. First time it was taken to OCI, 30 million. The first impairment was taken to OCI, which is 20 million, meaning that the impairment remains how much? 10 million. Now you can see the movement here. You can see the movement here. 30 became 10 because an impairment of 20 coming. Then a further 10 is taken, nothing remains here, and then 5 goes to profit or loss account that period. You can see 5 goes to profit or loss. So the first impairment of 20 million reduces this. The second impairment, 10 will come here, 5 will come here, everything will be 15 impairment. And then here, we are going to be having this revaluation surplus. So when you are an asset that has gone up before, and the revaluation surplus is taken to other comprehensive income, when it is impaired, first we must reduce what was previously taken to other comprehensive income before we can take the rest to profit or loss account. That is the explanation of Mr. David. Any other person? Madam DC, do you have anything to say? Do you have anything to say? Mrs. Ogunle, rain is falling heavily here and covered. Do you have anything to say, Mrs. Ogunle? Okay, yeah. Mr. David said thank you. Madam DC, are you there with us? You can just use the chat box. And use the chat box. If you have anything to say, I want you to respond. If you are okay, just say I'm okay, so that I can quickly go to the next exam. And if you have anything to say it. We are supposed to close at 7. Hello, I'm waiting. Okay, Mr. Ogunle say I'm okay. Okay, Madam, what about you? What about you, Madam? Are you fine with what we have done? Please use the chat box. Can you hear us? Can you hear me? Where you are? Okay, I guess maybe you cannot hear. You know, sometimes when people are online, maybe you can just left your phone to excuse yourself for a minute. Okay, I hope you are fine. You can hear us because I can still see that you are there in the group. I see you are there in the group. You are listening, so that's okay. So quickly, let's go treat the next example. So we have treated this example now. Asset, the same asset going up and down. So the next thing we are having here says, example, an asset was purchased 3 years ago at the beginning of year 1 for 100,000 naira. Its expected useful life was 6 years. Now, this is a depreciable asset. It has lifespan. And its expected residual value was 10 million naira. It has now been revalued to 120, and its remaining useful life is estimated to be 3 years, and its expected residual value is 15, is now 15,000. The straight line method of depreciation is used. Required. What amount should be recognized in other comprehensive income at the end of year 3, and what is the annual depreciation charge in year 4? So, the third one, what is the kind amount of the asset at the end of year 4? What is the kind amount of the asset at the end of year 4? Now, this is a revaluation of a depreciable amount. Okay, Madam has responded. This is a revaluation of a depreciable asset. Now, look at it. This asset was purchased 3 years ago. You can see they did not give us date here, but we can work with it. 3 years ago at the beginning of year 1. So initial cost was what? 100,000, sorry. Its expected useful life was 6 years and residual value of what? 10 years. So initially, what's going to be the depreciation charge on this asset? Cost minus residual value divided by the useful life. So let me quickly do that as our example. Sorry. Let me close this. So I'll quickly do that as our example 4. Let me move on. Example 4. Example 4. Example 4. Example 4. So in this example, we are going to be first looking at computation of depreciation charges. Computation of depreciation charges. Okay. His own topic also will be what? Movement in the value of an asset, but this time I will call it a depreciable asset. movement in the value of a depreciable asset. A depreciable asset as a result of revaluation surplus. Movement in the value of a depreciable asset as a result of revaluation. So first, I'll first want to do what? Computation of depreciation. Computation of depreciation. Computation of depreciation. That's what I want to do first. Now, cost. The formula for depreciation, which is what? DIP. Call it DIP. Just using short word for it. Equals to what? Cost minus residual value divided by useful life. For straight line method of depreciation. So let me have that clearly written, just as a reminder. I know you will remember, but that's how we are going to have it done. That's the formula for depreciation. So in this case, depreciation will be what? What is the cost of this asset? It was 100 million, and residual value is what? 10 million, and the useful life is 6 million. So we come and say 100,000, minus 10,000 divided by 6 years. That's going to be the formula we are going to be using for calculating our depreciation for each year. So what's going to be depreciation? Depreciation will be what? 100, that's equals 100,000 minus 10,000. I put that in a bracket using the formula here. Put that in a bracket. 100,000 minus 10,000 divided by 6. So depreciation charge is what? 15,000 naira. Depreciation charge is 15,000 naira per year. And don't forget what they are now telling us for 3 years now. 3 years depreciation now. 3 years depreciation. 3 years depreciation will now be what? Let me put it clearly. 3 years depreciation will now be what? 15 million times 15,000 times 3 to be this times 3 times 3. That's going to be 3 years depreciation charge on this asset. So let's read the question again. They said an asset was purchased 3 years ago at the beginning of year 1. Its expected useful life was 6 years, and its expected residual value was 10,000. It is now revalued. That is, after these 3 years, we now revalue the asset. That is, at the end of year 3, after we have done the depreciation for year 3, we now revalue the asset to 120. Its remaining useful life is now estimated to be 3 years, and its estimated residual value to be what? 15 years. So useful life does not change because 3 years depreciation was charged, and now we still have 3 years remaining. So there's no review of the useful life. However, there's a review of the residual value. So the first requirement is how much is recognized in other comprehensive income at the end of year 3. They want to deal only with year 3. So for year 3, the value of the assets, let me move the Naira sign that we need here. Okay, just put the hash. As at the beginning of year 3, which is 31, as at the end of year 3, the end of year 3 is 31, 12, Y3, and for year 3. As at that time, what we are having as the value of the asset is what? The value of the asset is 100,000 minus the accumulated depreciation today, which is 45,000. That's going to be the value of the asset as at this date that this review was done. And that's going to be what? What's going to be that value? It's going to be, I say equals, using my formula, equals 100,000 minus 45,000. The value of the asset was 55,000 as at that day. That's as at this date. But then there is a revalue. There's a revalue. They now said they are on first, which will now be the beginning of year 4 now. 1st of January, Y4. That is immediately after this time was when the revaluation was done. The value of the asset has now gone to how much? It is now revalued. The asset has now been revalued to 120,000. So 120,000 is the value of this asset. 120,000 is what they revalue the asset to. Can you see exactly what we are talking about, everybody? They revalue the asset to 120,000. So what has happened? The difference between what the value of the asset now is and what it should have been is what? 65,000 naira. We call that one revaluation surplus, which is now the value of the asset, revaluation surplus. Of how much? 65,000 naira. That's it. That's what the value, that's excess on the value of the land. So they are now asking us, the first question says what? The first question says, what is the amount recognized in other comprehensive income at the end of year 3? At the end of year 3, which is when this revaluation was done, where the double entry will be what? Double entry. So let me put here, double entry at the end of year 3. Double entry at the end of year 3. The double entry at the end of the year 3 will be what? Let me put the naira sign here. First, I do debit, and then credit. So then the naira sign can come. Like that, and then I have it like that. So the double entry will be what? We are going to debit the item of PPE. He didn't give us the name of the asset. He said an asset. He didn't give us the name. So we debit, we call it PPE. So we debit PPE. PPE will be debited. PPE, which is an asset. We are going to debit it with this amount of revaluation surplus, 65 million, and we are going to be crediting other comprehensive income, OCI, with this amount of surplus that we have. That's it. So when the first question said, how much is recognized in other comprehensive income? The amount that will be recognized in other comprehensive income is 65,000 naira. That is the increase. That is after the depreciation has been considered, and then we took the accumulated depreciation out of the cost of the asset. We have 55 million. That's the value of the asset. But then they revalue it to 120,000. So therefore, there's an increase of 65,000 naira on this asset. So we say being a revaluation surplus on the asset. Being the revaluation surplus on the asset. Being the revaluation surplus on the asset. That's going to be the explanation we are going to be giving this being revaluation surplus on the asset. That's it. So the second, that's part A. That's A of the question. A. That's A. So B now said, what is the annual depreciation for year 4? We need to now know what's going to be the annual depreciation for year 4. That's another part. So B, let me answer part B of the question here. Part B. That's B, the question. Part B. Annual depreciation in year 4. So now the new value, when we want to depreciate this asset, we'll now begin to depreciate it based on its fair value from that day. So the fair value of the asset as at this day is what? Fair value. Fair value. The fair value of the asset as at this date is what? Is 120,000. 120,000. That's the fair value of the asset. The residual value, residual value. The residual value as at this date is what they gave us in the question. The residual value is now 15,000. So here we say 15,000. That's the residual value of the assets at this date. So what is the depreciable amount of this asset? Let me put it here. Depreciable amount. Depreciable amount. The depreciable amount of the asset is the difference between the two. So let me say it's now, so definitely let me put this in bracket for easy calculation from my end here. Then put this as negative figure so that when I just say you should sum them up, it will give me exactly what the depreciable amount is. Now that's the depreciable amount. Now the useful life remaining, let me put it there. Remaining useful life. Remaining useful life of the asset is what, according to the question, is 3 years. 3 years. 3 years. 3 years. Therefore, depreciation charges for year 4. Depreciation for year 4 is now going to be the depreciable amount, which is 105 divided by the the remaining useful life, which is 3. And then we're going to be having 35,000 naira as the depreciation charge for year 4, as against the 15,000 naira we were charging previously. So we will do financial statement extract for you to be able to see how this will appear. So that's part B of the question. So we go quickly to part C. They say, what is the kind amount of the asset at the end of year 4? So the kind of amount of the asset at the end of year 4, C part of the question now. C part of the question. C part of the question. Carrying amount at the end of year 4. Kind amount at the end of the year 4. And that's very simple. We are going to be, let me have our Naira sign here. Okay, I should have even put the Naira sign there too. Okay, because we need to always have our information the way it should have been. So let me move this one. The Naira sign must be here. So that's working for C now. So we have the Naira sign here, the Naira sign as usual, and then we are going to be saying what's going to be the carrying amount. The carrying amount is going to be the new value of the asset, fair value of the asset, as at the beginning of year 4, which is how much? 120,000 minus the depreciation we charge for the year, which is the current accumulated. Don't forget, the old accumulated depreciation is gone. The asset has been revalued. It's not using historical cost again. Definitely, we are not going to be having the old accumulated depreciation. But in the double entry, I will show you how you are going to write off the old accumulated. So the depreciation now is the current depreciation charge for the period, which is what? 35,000. 35,000 naira. Sorry. 35. Let me do that again. 35,000 naira. And so the carrying amount of the asset will now be what? The difference between these two. Difference between these two, which is 85,000 naira. That's going to be the carrying amount at the end of year 4. That's the carrying amount at the end of year 4. That's the carrying amount at the end of year 4. So answer question A, knowing how much will be taken to OCI, 65,000 naira. And then question B, what the depreciation charge will be for year 4. Okay, I did not put year 4 here. Year 4. It's going to be 35,000 naira. That is the remaining useful life as at that day is what we are going to be using to divide the depreciable amount of the asset, and so it's going to 35,000 naira, and the kind amount will be 85,000. So quickly, let's look. Okay, we have done double entry here. What's going to be the double entry here? The double entry here is that asset. Okay, let me do it this way. The double entry. Double entry. Let me put double entry here. Double entry. Double entry. Double entry. The double entry is that debit, credit. Sorry, debit, credit. The double entry here is that the fair value of the asset has become this. So definitely we are going to be debiting accumulated depreciation. Accumulated depreciation. With how much? As at this day, accumulated depreciation is what? As at these days, accumulated depreciation is what? Is the 45,000 naira that we had here. That's the accumulated depreciation after 3 years. That is the depreciation for year 1, year 2, year 3 added together. So it's going to be what? 45,000. 45,000. Then we will credit, when we debit accumulated depreciation, we credit the coming. Accumulated is debited to write off what was previously there. So we are going to be crediting revaluation surplus. Okay, we need to also debit something. Okay, first, let's go to credit revaluation surplus so that you know how much revaluation surplus, or let me call it OCI, credit OCI. Credit OCI with how much? We credit OCI with 65,000 naira, which is what we credit to OCI. And so we are going to be having the remaining debit goes to PPE. Okay, let me do it this way. Wait, you will see the movement now. When we debit accumulated, let me credit the asset with the same amount that was previously there. Okay, no, sorry, I'm trying to debit accumulated depreciation to write off what we have, and the write-off goes, okay, the write-off goes into revaluation surplus. That's true. So what remains in the PPE is that we are going to be crediting PPE with the remaining amount, the asset. The asset will be credited with the difference between this, which is going to be 20,000. Let me just put the figure here. For this to be balanced, let me now look at the picture clearly again. Now, initially, asset was supposed to be 55, which is going to be the kind amount after we have deducted these depreciation charges. It's supposed to be 55. So we debit it again, writing off. Okay, quickly, let me quickly check. It's revalued upward. It takes revaluation of 65, and land also takes 65. So the accumulated depreciation is written off to other comprehensive income. And then the assets upward review. The asset upward review goes to the assets. Then there's one more credit leg. Let me quickly look at it. Depreciation henceforth is 35,000. That's correct. I'm looking at how we write off the accumulated depreciation account. We debit these. We take it to the asset. Yes, so we credit the asset. No, debit the asset, sorry. Debit accumulated depreciation, yes, because it was previously credit. We are going to debit it to write it off. And then credit. Yes, now I see it. Credit profit or loss. Sorry, I need to explain something here.
don't forget that the depreciations we have been having in the past were going to the statement of profit or loss. Now, let me first write this off. Now, we have missed something here. This is not how much we go to the OCI. Please pardon me. Let me quickly make the adjustment necessary here. The OCI will not take all the money. Why will the OCI not take all the money? Is because previously we were debiting profit or loss account with the depreciation account. We're debiting it. So profit or loss will take his 45,000 back first. The remaining is what we go to OCI. Please, I'm trying to create space here so that we can have this. OCI will now take the remaining one. So in this part, was it part A question that was asking how much should go to OCI? Let me look at it again. Okay, and this part that say how much should go to OCI, the amount that will go to OCI is what? The difference between this, the new revaluation amount, and this one that goes to profit or loss. And so it's going to be 20. This is going to be. So the answer is that 20,000 naira will go to OCI. That's the truth. 20,000 will go to OCI. PPE will take 65, which will boost it up. 20 will go to OCI. And 45, which was previously debited to profit or loss, as far as depreciation is concerned. Don't forget, profit previously was being reduced by the depreciation we were charging. Madam say, not following in the last example. Okay, you will see the video. The video is there for you to watch. Probably you were busy with something. That's the way it is. But you will see the video. You will see the video. Please, Ms. Ogunleye and Mr. David, are you in class? Please just type yes in the chat box. Let me know you are there. I'm supposed to round up now. This is the last example. Just say you are okay. Yes, you are in class. Ms. Ogunleye, are you still there? Are you still there? Quickly respond too, so that let me just round this up and close now. Even me, I'm running behind schedule. I still have that things to do. Are you there, Ms. Ogunleye? I can't see you. I can't see your response. I see you online, but you are not responding. Are you still there? Are you still there? So please signify so that I will know exactly. Okay, maybe you can't hear me. I know you are still there. So that is it. 65 goes to PPE, 45 goes to profit or loss to reverse the previous depreciation, and then only 20 will go to OCI. This is how revaluation surplus is recognized in a depreciable asset. The ones we did previously were assets that will not be depreciated, land. But now, if it's an asset that is depreciated and you are recognizing revaluation surplus, write off all the accumulated depreciation, credit profit or loss accounts with this. This is a double entry on. So being the journal to write off accumulated depreciation. Being the journal to write off accumulated depreciation. That's the definition of this journal. Because we need to know why we no longer can have balances in accumulated depreciation, that the depreciation will now be 35,000. It is written off in year 2 when, sorry, $100,000 minus 30,000, and then here we are going to be having 100,000 minus 45,000. Sorry, 45, which is accumulated depreciation. And so here we are going to be having this kind of amount that we had
here, which is 85,000. And so we go to statement of changes in equity. Statement, that's equity. And under equity, we are going to be having, revaluation surplus. And that revaluation surplus only occurred in year 3. And how much is it? The amount that we took to OCI, which is under this will come here. That's going to be the financial statement extract. This is balance sheet. And then this is profit or loss. This profit or loss. Let me first clean the line that was there previously, and then I can have the proper line here. Profit or loss. Let me now have the proper line. Have it. I'm just trying to mark it. Profit or loss, balance sheet, then the various journals under example 4. The various journals under example 4. The various journal, year 3 has its own stocks here. And then year 4. Okay, sorry, I should have extended this down to this place. Sorry, it moves. And here we have this part B of the question answered here. And then we have part C answered here. And here is the journal for writing of the accumulated depreciation that existed previously. That is it. That's it. So I hope you enjoyed the class. I know some of us might not be online now. What's wrong? I can't hear you. Madam, I thought you said you are not. Okay. What's wrong? Can't hear you again. That's what the madam said. Okay. The network went off, but I'm back online. Don't know if you are there. I'm back online. And the video also captures all the video and recording also captures everything. So you will be catching up with every other thing in the video. So thank you for your time today. I wish you best of luck. I hope that you enjoyed the class and that you enjoyed the video.